Hello everyone, my name is Stuart Coulthard and thank you so much for coming along to our latest webinar. Today's topic is things to do before the end of the financial year, and you are up for a treat. We've got 4 presenters today, myself, Eliza Smith, Adam Jacobson and Mark Debblejack. So strap in and enjoy. What I wanted to cover off on first is at the moment we are having a lot of conversations with our business clients. And I wanted to cover off on some of the common questions that our clients are talking about or asking about us when we're having our tax planning meetings of things that we can do before the end of the financial year. So the number one question that I'm getting asked is, how is this financial year or end of financial year different compared to last year? I guess in a contrast compared to last year, there was lockdowns, there was COVID payments. So there was a lot different. So businesses were having a lot of trouble forecasting what they were actually going to do post 30th of June. So making better business decisions was really, really tough to do this time last year. This year, everything's different. Our clients are actually making forecasts now and they're actually making better business decisions now, and they're actually going forward to actually make everything or putting plans in place with some certainty. The other thing as well is last year, clients were receiving COVID payments. So it was there was distorting the financials and everything. So it was now, I guess, with the payments being lifted out of businesses, you're actually getting a true indicative look at what your business is worth or what's it actually doing without JobKeeper and grants going through your payments. So again, that is a bit different compared to last year. The next question is what do accountants, what are we looking at when we're reviewing clients' financials? I guess what we are looking for is outliers. So what is different? What has occurred during the financial year that looks a bit different? With these outliers that are actually occurring, is what we try to look at is what is the tax treatments of them? Are they assessable? Are they deductible? The other thing we're reviewing is trends. So with trends, you can predict certainty or put some forecasts in place to, again, make better business decisions. The next thing is impact on JobKeeper. How is the JobKeeper payments that are being received by your business affecting your business? I guess one thing that we run or tell clients, which they may not be aware of, is that JobKeeper payments is assessable. So you've got to pay tax on it. The other thing is it does inflate your wage costs. So with JobKeeper finishing up at the end of March, all of a sudden we have a true idea of what wage costs will look like. So again, we can forecast and plan for those sort of things. So again, JobKeeper payments are no longer in place. We can make decisions around staffing and wages and costs like that. And probably the main thing that clients talk to me about this type of year is, how do I pay less tax? And what they're really asking, I find, is what can I go out and buy now to get a tax deduction? And I often answer that question is, do you actually need that expense? Do you actually need it? Because again, if you're operating out of a company, you're getting a tax deduction for 26% on that expense. So you're still outlaying another 74% in every dollar for every cost that you spend. So do you really need it? So speaking of general things that businesses should consider before the end of financial year, I might touch on here that this is general advice. So it may not be right for you. So come talk to us, give us a phone call, drop us an email to actually ask us, should you be doing this sort of stuff before the end of financial year? So again, this is very general stuff. The first thing that I touch on is complete a stock take. So if you've got inventory, going out there and counting the stock that you've got. That'll give you an insight on where you are positioned at the moment with your inventory. The right things, are they selling, are they not selling? And if they're obsolete and not selling, write them off before the end of the financial year. You get a tax deduction for that. The next thing is making an immediate, going out there and purchasing equipment. First of all, do you need it? Only buy what you actually need. But if you buy something today, being equipment, being cars, vans, trucks, IT, if you go out and buy it today, you will get a tax deduction for it before the end of the financial year. You could go out on the 29th of June and buy the pieces of equipment, and even the 30th of June, and still get a tax deduction for the full cost. If it's a car though, there is a business use percentage for it, so you can only get a tax deduction for the business use. And there are and also there's a motor vehicle cap on those things too. So there are rules around cars, but everything else, generally you can get a tax deduction for the full thing. The next thing that I talk about is small business pool write-offs. What I mean by there is most businesses have a depreciation of their plant and equipment that they've got that they're depreciating over a number of years. If that pool or the total value of the written down value is below a certain amount, you can actually write the whole thing off. So that's pretty good as well, an accelerated depreciation system. What I'm talking about here is, this is one of the main things that I have a lot of conversations with my business clients, is paying your staff super before the end of the financial year. Why do I say that? Is if you don't actually physically pay it, so it's got to go out of your bank account and hit the super fund's bank account. If you don't do that, you don't get a tax deduction. Super has to be paid. That's as well as your super as well. Also, paying a bonus. So if you're thinking of paying a staff bonus or paying yourself a bonus, that'd be nice. Actually getting it documented, actually recording it, and actually paying it before the end of the financial year, you'll get a tax deduction for that. Reviewing your debtor ledger is something that I think is best practice in your business. And reviewing it before the end of the financial year is also a key time. It's a good time to actually review it to see if there's any bad debts lying around that you can get rid of. Because if you recognise a bad debt, again, you get a tax deduction for that. So if you've got some debtors that have not paid you, why not review your ledger and get rid of them or strike them off? Or first, probably follow them up first just to see if they're going to make pay. And getting payments better than no payment. But if they're never going to pay, write them off and get a tax deduction for it. A couple other things here is some considerations that I think business should think about. In terms of expenses, can you go out and prepay for some type of expenses? Because again, if you're dragging forward that expense before the end of 30th of June, you get a tax deduction in this year. And either paying your rent, interest, this is just a general examples for it, marketing and insurance. You can, if you pay for it this side of the 30th of June, tax deduction for you. The other side is, can you push out income to the end of the next financial year? Obviously, you've got to weigh that up of if you're pushing an invoice out to the next financial year, will that delay payment? So would you prefer to recognise or get the cash now compared to the financial year? So that's something you need to consider if you're going to think about pushing income out to next year. Bear in mind though, if you're operating a company, if you're operating a business out of a company, the tax rates do come down to 25% next financial year. So you'll pay less tax next financial year if you're operating a company compared to this financial year. So that's consideration for it. More specific expenses that you can consider paying is repairs. So does your van, does your truck need some repairs? Does your office need some repairs? Getting it all done before the end of the financial year, paying for it before the end of the financial year, you'll get a tax deduction. So things that, I guess the things on the screen at the moment, you're going to spend this money anyway, rather than just some random thing that you don't need. So stationery, printers, printing, branding, software. So all of these things that you may incur anyway, getting it done before the end of the year. A comment that I've got there is, if you start your business up this side of the financial year, if you start that up, all the costs associated with the startup of that business is tax deductible. So if you're thinking about starting a business up, rather than doing it in July, maybe thinking about it doing this side of the year, because again, you get a tax deduction. And the last point on there is income protection insurance. If you pay for that again for this financial year, you get a tax deduction for that too. Still going. The next thing is around looking at structuring your debt correctly. And what I mean by that is, do you have debt that you're not getting a tax deduction for it, be it your home or anything like that? So thinking about the debt that you actually have and whether it relates to business, whether it relates to an investment product, structuring it up so you're actually making that debt work for you. You are getting a tax deduction around it. Other specific things that or best practice for business is actually having employment contracts. So if you've been putting off employment contracts for your staff for whatever reason, you probably should have an employment contract for your staff. Go out there and arrange for these little things, getting it done before the end of the financial year, and paying for the costs and getting a tax deduction for it. These are best practice stuff. You probably should have it anyway, and it's not just going out there and spending. Terms and conditions as well, keeping them up to date. Reviewing your trademark should you go out and trademark. Again, spending the money now, or staff training. So these are all specific expenses that businesses will think about doing it, but should you think about it, should you be engaging professionals to organise this, because you do get a tax deduction for it. So that's the end for me. What I'm going to do now is get Eliza on here, and she'll cover off on a few other topics around businesses and what they should do before the end of the financial year.
Good afternoon, everyone. My name's Eliza Smith and I'm a manager here at Rubik's, and a big thank you to Stuart for all the fun things that you should be doing before 30 June. Today, I will be talking to you about all the paperwork and all the things that are necessary. So it may not be as fun and sexy as Stuart's presentation, but these are things that need to be done. So the first thing I want to speak to you is our trust distribution minute. So for anyone that has a family trust, we will prepare a trust distribution minute for you to sign and send back to us before 30 June. A trust distribution minute is a minute to describe where the income of the trust is going to go at 30 June. The same for our company clients. So if you're going to prepare a dividend and pay a dividend to the shareholders, this documentation needs to be signed before 30 June, and the payment does need to be paid before 30 June to include it as income in this financial year. As Stuart was saying before, as part of our tax planning, we speak to clients about establishing a company as a beneficiary of their trust. Now, if this is something that we have discussed with you, we are in the process of getting that set up. However, it is something that needs to be done before 30 June. The company needs to be incorporated and everything set up and running as a company. As a company, the flat rate will either be 26 or 30% for the year 30 June 2021, and it is also a better tax planning for the trust. Division 7A. So I'm not going to get into the nitty-gritty of this because it is quite a complex matter in tax law. However, if you have a Division 7A loan, no doubt you've heard from myself, Mark and Stuart about this matter, and there is a current loan in place. So for a quick little rundown, a Division 7A loan is when a shareholder or a beneficiary of the trust takes money out and is not repaid before 30 June. So before 30 June, at Rubik's will make sure that you do your minimum repayments, any interest is declared, and also that the loan agreement is up to date. Payroll tax. So this is the state tax on the wages. If your payroll every month, including superannuation, is at 54,166, you will be eligible for payroll tax to be lodged before the 21st of July 2021. If you think that your wages are going to hit this level, or if we've flagged it with you, we'll ensure that your registration is done. Stp Obligations. So Stp stands for single touch payroll. It's a way for the ATO to measure and report the wages every pay cycle, whether it's weekly, fortnightly, monthly. All employers, so if you pay yourself just a wage and you're the only employee, need to register for STP from 1 July 2021. So if you are a bookkeeping client of ours, don't worry, it's on the books. We're making sure that this is prepared. The small business income tax offset. So this is $1,000 that you get to reduce your income tax bill. Now, there's only 3 business entities that can get this. It is a sole trader, a partnership, or a trust. If you do run your business through a partnership or a trust, then this gets distributed to the partner or the beneficiaries. If it's in your sole trader, you'll see it as an offset against any income tax payable. The maximum of the offset is $1,000, and your income of the business has to be $5 million or less for this financial year and the next few upcoming financial years. Motor vehicle logbooks. Everyone loves to claim motor vehicle for an expense as a deduction. However, you need to ensure that your motor vehicle logbooks are up to date. So I know people don't like tracking these things, but we need to get it done. So please ensure that at least 12 continuous weeks have been recorded in your logbook before 30 June 2021. That proportion of that logbook is what we can claim as a motor vehicle expense, whether it be fuel, repairs, depreciation on the car. And I do want to repeat 12 continuous weeks so we can get the right percentage. Make sure you also include the closing and opening odometer readings. Well, hasn't COVID changed the way we've worked? And the number of staff and business owners working from home has increased. So the most important thing for you to claim that home office expense, such as your electricity, your gas, your internet, is to make sure you log the hours you work. Now, this can be as simple as a spreadsheet or keeping in your calendar when you're working from home or when you're working in the office, but you need to ensure that you're logging the hours that you work from home. You also need to ensure that you measure that place that you're working from home. So you can't just claim 50% of the electricity if your office is only 20% of the home. Now, these are all to make sure that we are covered by the anti-avoidance warning and that we have every T crossed and every I dotted. So the ATO will come looking for motor vehicle logbooks and home office. I have seen clients, unfortunately, had motor vehicle deductions disallowed because of they weren't allowed to show a logbook. So to summarise, paperwork, yes, it's all before 30 June 2021, but at Rubik's we have that checklist. Please don't avoid our emails with those important attachments and signatures, and make sure that you get them back to us before 30 June 2021. So now I'll hand over to Adam Jacobson, who will speak to you all about things individuals.
Thank you, Eliza. Today I'm going to be speaking about what you as an individual can do to prepare for end of financial year. So firstly, we're going to touch on income. We'll start with salary and wages. So in the past, you'd have to request or receive from your employer a PAYG summary or group certificate. Now there's no longer a requirement to do this, and this started at the end of last financial year. Now your employer has the obligation to lodge everything through what's called single touch payroll or STP. And once they lodge the STP finalisation, all that information regarding your salary and wages will be available on the ATO portal, and we will have access to that. So in regards to that, you don't need to do anything there. You just have to rely on your employer. Next, I'll speak about shares and securities. So similar to salary, your dividend information should already be available on the ATO portal. This, of course, is only possible if you've notified your relevant share registry of your TFN. So you can do this, you can log on to your share registry such as Computershare or Linked, and you can notify your TFN there. If you haven't already done so, I would recommend doing that. Therefore, you wouldn't have to be gathering all the dividend information every financial year to be provided to us. Now, unfortunately, if you've made some share or security sales, you will need to go and collect purchase and sales contracts to assist us in determining your capital gains tax, if any, payable. Okay, next we're going to be speaking about deductions, everybody's favourite topic. Eliza already touched on this, but I'll speak to you about motor vehicle expenditure. So there are two methods available. There's the Logbook Method, and then there's also the cents per kilometre method. So we'll touch on the Logbook Method. So some of you might be looking to use this method and you haven't done so in the past. There might be some of you who have used this. However, when it comes to the Logbook Method, you're required to keep a logbook. Now, this logbook is valid for a 5-year period. So if you are looking to use this method moving forward, you're going to have to create a logbook. If your logbook is expired, it's coming up on those 5 years, then you're going to have to renew that logbook. Now, to do so, you're going to want to do that before the end of financial year. So that is 30 June 2021. Now, the other method available is the cents per kilometre method. Now, what you get from that is you get a rate of 72 cents, up from 68 cents from last year. And you get, for every kilometre driven, 72 cents. So you can claim a maximum of 5,000 kilometres, and this is based on a reasonable estimate. So that's more of a simplified method as opposed to the Logbook Method. So both are available to you. Next, we'll touch on briefly laundry expenditure. So when it comes to laundry, you're not actually required to keep receipts for expenditure up to $150. So there are some rules to that, and these rules are: it only includes for expenditure, for laundry expenditure for occupation-specific clothing, protective clothing, and compulsory uniform. So for somebody like myself who comes to work in a suit every day, unfortunately I can't claim any laundry or dry cleaning on my suit. So it would only really apply for somebody who have those 3 types of clothing or uniforms, as I previously just discussed. So that's laundry in a nutshell. Next is a hot topic, home office expenditure. So there are 3 main methods. I'm going to be touching on 2 of them. The first is the Covert shortcut method. So something in regards to this is that this has now been the first year that first financial year, I should say, that we've gone through a whole year under COVID-19. And most of you would have been working from home, and so this would be definitely relevant to you. So the Covert shortcut method is where you can claim 80 cents per hour work from home. This is basically a quick way to calculate your home office deduction. So something to note with this method is that it covers phone, internet, decline in value of equipment and furniture, electricity and gas. So if you were to be wanting to claim those expenditures separately, you wouldn't be able to under this method. Now, as opposed to this method, there's the actual cost method. So for all those expenditures that I just listed, phone, internet, electricity and gas, with the actual cost method, you would determine the actual cost, as the name suggests, and apportion it based on work use. So there would be various methods depending on the expenditure that you would then apportion it based on. So those are 2 of the 3 available to you, and I'm sure a lot of you will be in contact with us to help determine which method is actually best for you. However, in the interim, it's good to gather documentation such as your phone bills or your internet bills, electricity and gas bills, or even come up with a reasonable estimate of how many hours you work from home. Moving on to offsets. So this is one better than a deduction. So I know a lot of you are interested in this, the low and middle income tax offset. So as per the recent budget announcements, it's been extended for another year, which is fantastic. So there's absolutely nothing you need to do. You will receive this regardless, and we will ensure that you receive it. So it is worth up to $1,080 per individual, and it depends on the taxable income you've earned. So there is a threshold. So once you reach up a certain amount of income, it then slowly fades out. And if you're under a certain amount of income, again, it'll slowly fade in. So depending on where your income sits in the tax brackets, depending on how much you'll get of this. In summary, now's a great time for you to start gathering your documentation, getting ready, especially if you're going to be getting that refund, getting it all together. And if you have any questions for us, come speak to us. And yeah, I hope you've gained some insight from this. And next speaking will be Mark Debblejack, Director at Rubik's.
Thank you, Adam. Very, very hand tips about being an individual. I'm here to talk to you this afternoon about the budget. The budget was a big spending budget, probably the biggest spending budget that there's ever been in Australia, and they're forecasting a deficit of $161 billion. Now, it is less than what they were forecasting 6 months ago, but it's still the biggest budget deficit that this country has seen. They've concentrated mainly on the pandemic spending and stimulus. In there, they're trying to stimulate business and employment, and pandemic spending is obviously protecting Australians, whether it be hospitals or vaccines or closing the borders and that. So also highlighted in the budget was the response to the aged care crisis that we have, and also there's a big amount in there for childcare. And interestingly enough, the government has put aside $3.8 billion for women, and that is protection, develop opportunities, and to try and reduce the pay gap. I've chosen to highlight some of the business tax changes here. I mean, there are a lot of them, but The government has confirmed for smaller business that the tax rate for smaller business is going to drop from 26% to 25% if that business is run through a company. If you happen to run your business through a family trust and have a corporate beneficiary, as long as you qualify as a small business, then you'll also be paying 25% tax. So that starts on the 1st of July 21. The government also announced the full expensing of plant and equipment will be extended one further year. So it was due to finish at the 30th of June 22, and now it's going to run to 23. So that's where you get the full tax deduction for plant and equipment. Motor vehicles is up to the motor vehicle cost limit, and obviously IT and all that sort of stuff. In addition, the government has announced the tax loss carryback will be extended for another year. So that's where if, for example, in 21, due to COVID, you had a loss, and you can go back a year and claim credits for the tax you paid in that year. So there might be some clients this year that weren't that affected by COVID in 2020, but have made horrendous losses in 21. They might be able to claim back some of this. And that loss carryback is going to extend for another year till June 2023. Also in the budget, there's a lot of spending on training and boosting employment. So there's a whole lot of different myriads of schemes, a lot of training. So that is going to obviously affect employment, and they're trying to get to what they call full employment, which is about 4% unemployment. For the individuals, Adam touched on the first one here, the lower middle income offset is claimable in 21, but it's also going to be there for next year. So that was originally due to expire on the 30th of June. So we've got not one more year of that. And the only way to get that offset, if you qualify, is to actually lodge your tax return. The government also announced some changes in residency. So if you live part of the time out of the country, part of the time in the country, and we have quite a few Rubik's clients that do that, they're going to simplify the rules. They haven't announced how they're going to simplify them yet, but they say they're going to simplify it. So that should be something for our non-residents or people who are thinking about becoming non-residents will need to talk to us about. The government also has increased the first home buyers super release, and they're allowing people to take up to $50,000 of their super to buy their first home. Also, there's more places in the first home buyers scheme. There's 10,000 places where you come up with 5%, the government will guarantee the other 15%, so you're not up for mortgage insurance. Once again, you need to qualify. There's issues around values of houses. They're different across the states. So a house in Sydney, the deposit is higher than, for example, a house in Melbourne. Also, one of the unexpected things was this single parents first home buyers scheme. So it's similar to the one beforehand, but it's a 2% deposit, and the government will guarantee the 18%, so you're not up for mortgage insurance too. So you can see there that the government is really pushing home ownership in this budget. There were some changes in superannuation, unexpected changes. The downsizer contribution age has reduced to 60. It was previously 65, and that's from the 1st of July. And this is where if you sell your home and you have extra proceeds, you can put up to $300,000 individually into superannuation, or as a couple, $600,000, so 300 into each superannuation account. There is no age limit on this, so if, for example, you are 80 and you sell your home, you can put up to $300,000 into super from the proceeds of the sale of that home. And it doesn't matter whether you're at your 1.6 cap or whether you don't have a super account at all. What is important, though, is that the age is from 60. So it's a whole cohort of people that can now do it. Also, the government removed the work test for voluntary contributions for people 65 to 75. And a voluntary contribution is salary sacrifice or a non-tax deductible contribution of up to $100,000. Unfortunately, the taxable contributions or tax deductible contributions weren't included. You still have to have the work test for that. And the government has also announced some changes in the residency rules for super funds. So previously, if you left the country for 2 years, you would not be able to run, it would be very hard to run a self-managed super. And they've moved that from 2 years to 6 years now. We don't have the legislation, so when we do, we'll talk to the affected clients. So in summary, contact us if you've got any queries. And Stuart's going to join me now for a wrap up. Thank you.
Thank you everyone for getting this far in this webinar. So the topics that we covered off on today is things businesses can do before the end of the financial year, what individuals can do before the end of the financial year, and then Mark covered off on the budget or a budget recap. So if you do have any questions about anything like that, please give us a contact, either email, phone, or even fax if you really feel like it. But I guess the reason why we do these webinars is that we've got a real passion for our client success. Providing relevant commercial information to our business clients or all our clients really drives us. We want our clients to succeed. It's in our culture. And that's why we've got the Rubik's Care Factor. That's why it's so big for us, isn't it, Mark?
Yes, it is, sure.
But don't take our word for it. We actually did a survey for our clients a month ago just to see how overall satisfied they were with our services. But an overriding majority of clients were really satisfied with our performance on how we looked after them. The next thing that I wanted to cover, we're really proud about this, is that we made the decision last year when COVID hit or the pandemic hit to really look after our clients, to support them through it. So making sure that they were getting all the things that they could get when we were helping them through, stepping them through the process. And we've got some great feedback that's on the screen here. Again, an overriding majority of clients really happy, very satisfied in actually how we've supported them through the pandemic, which is awesome. Yes, so again, if you've got any questions about any of the topics that were covered today, please make sure that you either call us or email us. We're happy to answer these questions. Again, your success is really our passion, so please give us a call. This video will be online for your viewing pleasure, so it'll be going out for you. But if you want a specific section of the video, we're happy to send the video out to you as well. We've got a couple things on there. Obviously, follow us on LinkedIn, follow us on YouTube as well, like us on Facebook. I guess the reason why you do that is so you get the most up-to-date, relevant information for you straight away. So thank you. And that's it.
Thank you.